While most income investors are lucky to get a dividend payment once a month, what if I told you there was a way to get paid almost twice a week? Imagine an ETF, let's call it QLDY, that uses a wild lightning spread method to generate daily income. Is this the future of passive income, or is it a high yield trap just waiting to spring? Stick around, because we're about to explore it. Most investors are stuck in the waiting room. You buy a stock, you buy an ETF, and then you wait 30, 60, maybe even 90 days for that dividend check to finally land in your account. It's how things have always been done. And frankly, in a world of instant everything, it feels painfully slow. That lag time slows down your ability to compound, making your financial snowball roll just a little bit slower. And if you're trying to live off your investments, that long wait between payments can make budgeting an absolute nightmare. It's a huge problem that most of us have just learned to accept. But what if we didn't have to? What if an ETF completely changed the game? Picture this: an ETF with a secret method that pays you not monthly, not even weekly, but potentially every 3 or 4 days. In this video, we're going to pull back the curtain on exactly how a hypothetical strategy like this lightning spread would work, how much it could really pay, and the catastrophic risk that might just wipe out your investment. You're going to want to see this. Let's just sit with this problem for a second because every income investor knows this feeling. The magic of building wealth through dividends is compounding, reinvesting your payouts to buy more shares, which then make more dividends. It's a beautiful cycle. But the speed of that cycle is completely dictated by how often you get paid. When you only get dividends once a quarter, your money is just sitting there for 3 months. That's 3 months where it's not working for you, not buying more shares, and not getting you to financial freedom any faster. Monthly dividends, like those from the famous QYLD, were a big step up. They cut that waiting game down a lot. But even then, you're still waiting 30 days. Your cash sits in your account waiting for you to do something with it or for the drip plan to finally kick in. This lumpiness of income is more than just annoying, it's a strategic handicap. It makes managing your cash flow tough, especially if you rely on that income to live. An unexpected bill can hit a week after your dividend payment, leaving you high and dry for another 3 weeks. It's this deep frustration, the desire for faster, more consistent passive income, that has set the stage for a new breed of hyper aggressive ETFs. And the theoretical new kid on the block, a fund like QLDY, would take this idea to an absolute extreme. So let's imagine it: an ETF called the NASDAQ 100 Lightning Spread TM Income ETF with the ticker QLDY. Picture it coming onto the scene with a groundbreaking promise to be the first ever US ETF designed to pay distributions twice a week. That's right. While everyone else is stuck on a monthly schedule, this hypothetical fund would aim to put cash in your account around every Monday and Thursday. This wouldn't just be a small tweak to the old model, it would be a total reinvention of how an income ETF works. The core idea would be to match the speed of income with the speed of the modern market. Instead of letting option premiums build up for a month, an ETF like QLDY would be built to generate income daily and distribute it almost right away. On the surface, it's the perfect solution to the slow income problem. The compounding cycle gets slashed from 30 days to just a handful. The income stream becomes a smooth, consistent river instead of a few unpredictable floods a year. For anyone living off their investments, getting paid twice a week would be a dream. It would feel like a traditional paycheck, making budgeting incredibly simple. The fund would likely be actively managed and based on the NASDAQ 100, but it's what it does with that index that would make it so unique and, as we'll see, so dangerous. To see how it could possibly generate enough income to pay out twice a week, we need to look under the hood at its theoretical engine, the lightning spread strategy. So how would a fund like QLDY actually work? The secret is in the name, the lightning spread TM strategy. It definitely sounds like slick marketing, but it describes a very specific and aggressive option strategy that's key to generating daily income. First, let's start with the old guard, an ETF like QYLD. Its strategy is pretty simple. It buys the stocks in the NASDAQ 100 and sells monthly call options on the index. This is called a covered call. Think of it as renting out the upside potential of your stocks. You get a monthly rent check from the option premium, but if the market soars, you miss out on the big gains. It's a trade-off: consistent monthly income in exchange for capped growth. QLDY would take this a step further, using what's called a synthetic covered call. Instead of buying all 100 plus stocks, it would create a synthetic long position, likely by buying a deep in the money call option on the NASDAQ 100. This mimics the performance of owning the stocks, but can be more capital efficient. Now, here's where the lightning comes in. Against this synthetic position, the fund would systematically sell 0 days to expiration, or QDTE, put spreads. These are options that expire the very same day they are sold, the fastest paced corner of the options market. The time value of these options, or theta, evaporates incredibly fast. QLDY's strategy would be designed to capture that rapid decay as pure income. Every single day, the fund would sell these 0 DTE put spreads, essentially betting the market won't drop below a certain level that day. For taking that risk, it collects a premium. By doing this every single day, it generates a stream of income every day the market is open, which is what would theoretically allow it to make twice weekly payouts. It's an intricate, high turnover strategy built for one thing: maximum income frequency. But as you can guess, a strategy that relies on daily, high stakes bets comes with a whole other level of risk. We're about to get into the really crucial part, the risks. But before we do, if you're finding this breakdown useful, do me a favor and hit that subscribe button. It's free, and it helps the channel keep bringing you analysis on new and interesting investment ideas just like this one. Before we get to the nightmare scenario, let's be fair and talk about the dream. Why would anyone even consider a fund this aggressive? Well, the appeal is powerful. The most obvious pro is the insane frequency of the income. Getting paid twice a week is a game changer. It turns your investment from a passive asset that pays you sometimes into something that feels like a steady paycheck. For retirees, this could make financial planning so much easier. Instead of a big monthly payment followed by weeks of nothing, you'd have a constant trickle of cash. The psychological benefit of that, the sense of security and consistency, can't be ignored. The second major benefit is the potential for supercharged compounding. Like we said, the faster you get your money, the faster you can put it back to work. With a fund like QLDY, the compounding cycle is cut down to just a few days. Over a long time, this could theoretically lead to a much stronger compounding effect, since your money spends less time on the sidelines. Finally, there's the allure of the high yield itself. Strategies using 0 DTE options, like the weekly paying QDTE, often boast incredibly high distribution rates because the daily premiums can be huge. For an investor focused purely on maximizing current income, those numbers can be intoxicating. The combination of a massive potential yield with paycheck-like frequency is a powerful story. It's the promise of having your cake and eating it too. But now it's time for a reality check. This is the most important part of this video. The dream of bi-weekly payouts is tempting, but it would be built on a foundation of massive risks. Ignoring them would be a huge mistake. Risk number 1, NAV erosion, the slow bleed. This is the boogeyman of all high-yield options ETFs, and it would be a huge concern for a strategy like QLDY's. NAV, or net asset value, is the fund's share price. NAV erosion is when that share price slowly decays over time. Why? Because those high distributions you get aren't always profit. They can often include a return of capital, or ROC. Think of it like this. You have a block of ice representing your investment. The fund chips off a piece, hands it to you, and calls it a dividend. It feels like income, but you're just getting your own money back, and your ice block is now smaller. A significant portion of a payout could be nothing more than a return of your own capital. Over time, your total investment value can bleed away. QYLD has been criticized for this for years, with its share price trending down over its life. QLDY's aggressive strategy, which would involve daily trading and likely a high expense ratio, could make this process even faster. You might get paid twice a week, but if the share price is constantly falling, you could be losing more in principal than you're gaining in distributions. Risk number 2, capped upside, missing the rocket ship. This is the basic trade-off of any strategy that sells options for income. You are selling off your potential for big gains. The lightning spread strategy would limit your ability to participate in a strong bull market. If the NASDAQ 100 has a massive rally, a fund like QLDY would not capture all of that growth. Meanwhile, because it maintains exposure to the index, it would remain fully exposed to losses, which might not be fully covered by the option income. Over time, this can lead to dramatic underperformance compared to just owning a NASDAQ 100 index fund like QQQ. We've seen this with QYLD, which has lagged the total return of QQQ by a huge margin. You're sacrificing long-term growth for short-term income. Risk number 3, the lightning spread fails, the catastrophe. This is the big one, the risk unique to a fund like this. The strategy depends on the 0 DTE options market working perfectly every single day. What happens during a flash crash or a sudden market shock In a moment of extreme volatility, the prices for those 0DTE options could go haywire, making it impossible for the fund to run its strategy correctly. A sharp market drop could cause the put spreads it sold to suffer huge losses, wiping out far more than the premium collected. Because the fund resets its position daily, it's incredibly sensitive to these intraday swings. A monthly option strategy has time to recover from a bad day. A 0DTE strategy lives or dies by that day's price action. There's no guarantee the consistent biweekly income wouldn't just suddenly vanish during a period of market stress. This is the catastrophe. A strategy that seems to work perfectly in a calm market could completely fall apart in a crisis, leading to rapid and severe losses. To really get this, let's see how a hypothetical QLDY would stack up against the real kings of the income world. QLDY versus QYLD. This is the most direct fight. Both are based on the NASDAQ 100. QYLD is the original with a simple monthly covered call strategy and a 0.60% expense ratio. Our hypothetical QLDY is the aggressive challenger with a complex biweekly 0DTE strategy and what would surely be a higher expense ratio. Choosing QLDY over QYLD would be a bet that hyperfrequency is worth the higher fees and the untested nature of the strategy. QLDY versus JEPI. JEPI, the JP Morgan Equity Premium Income ETF, is often called a smarter income fund. It's actively managed and aims for a balance of income and some growth with lower volatility. QLDY would be the polar opposite. It's pure high-octane income focused on a volatile index. A JEPI investor is looking for stable, risk-managed income. A QLDY investor would be chasing maximum yield and frequency, accepting maximum risk to get there. QLDY versus QDTE. This is the most interesting matchup. The Roundhill N100 0DTE covered call strategy ETF, QDTE, also uses a 0DTE strategy on the NASDAQ 100 but pays out weekly. Both represent the cutting edge of income generation. QDTE sells 0DTE call options daily, while our hypothetical QLDY would use a synthetic position and sell 0DTE put spreads. They're two different ways to attack the same goal. QLDY would just be a sibling to QDTE with a slightly different method and a twice as fast payout schedule. Choosing between them is choosing between two highly speculative ideas at the frontier of ETF design. So, what's the final verdict on the idea of a fund like QLDY? There's no denying it would be one of the most innovative income ETFs imaginable. The promise of a biweekly paycheck directly solves a huge pain point for investors. The lightning spread concept is a fascinating, if incredibly complex piece of financial engineering. However, that innovation would come at a serious price. The risks aren't just there, they're massive. The threat of NAV erosion looms large, potentially eating away at your investment over time. The capped upside means you'd almost certainly get left behind in major bull markets. And most importantly, the complex 0DTE strategy is extremely vulnerable to volatility and could fail spectacularly in a crisis. For me, an ETF like QLDY is the definition of a speculative satellite position, and a tiny one at that. It would absolutely not be a core holding. This is a tool for a very specific person, someone with an extremely high tolerance for risk, who fully understands options, and is willing to lose a big chunk of their principal to experiment with a high-frequency income stream. This is not for beginners. It is not for anyone nearing retirement. The siren song of getting paid every few days is powerful. But the rocks that this ship could crash on are very, very real. As always, this isn't financial advice, just my analysis of an interesting idea. But now I want to hear from you. Is the allure of bi-weekly income worth the immense risks? Would you ever consider putting money into a fund like this? Drop your thoughts in the comments below. I read every single one. Thanks for watching.